Hello and welcome to Moneylife News and Views. I'm Debashis Basu. On June 4th, the Lok Sabha election results shocked the market and jolted the ruling Bharatiya Janata Party. But the market was perturbed for exactly 2 hours. By noon, stocks started recovering and within a week surpassed the all-time high it hit just before the election results. A month later, as the steady upward drift continued, the indices were much higher, still belying worries about a hobbled minority government. On the day that the union budget was announced, which is about a month and a half later, the markets fell due to the imposition of higher taxes on capital gains. Investors this time took 2 days to digest an uninspiring budget provisions. On the third day after the budget, indices charged up again, recording handsome gains. Internationally, wars are raging in Ukraine and Middle East, which has pushed up shipping costs and time. Domestically, worries include electoral setback for the ruling party, poor consumption growth, jobless growth as they call it, high actual inflation combined with extreme valuations in certain pockets of the market. And yet, the market is scaling new heights. What gives? With the benefit of hindsight, here are a set of factors which are fueling the bull market. Number one is government spending. For the first 5 years, the Modi government tried many tricks to push the economy ahead, but struggled to generate any meaningful growth. In September 29, depths of despair when the economy had recorded just about 4% GDP growth, the government slashed corporate taxes in the belief that businessmen will use the money saved to invest and expand. It was a knee-jerk reaction. Grateful businessmen mostly held on to the savings, partly spending it on dividends and buybacks. They did not invest more, and tax cuts failed to create new jobs. During COVID-19, the government was forced to adopt reflationary tactics to keep the economy going, which boosted economic growth and led to higher stock prices. A higher growth combined with high rates of goods and services tax, which finally was implemented strictly, led to booming revenues for the government, giving it an elbow room for a second gamble, which is massive capital expenditure by the government in highways, expressways, and defense and all sorts of infrastructure projects. This kicked off a huge growth for a large number of listed companies, many in the small and mid-cap space, which is why these indices have done much better than the large-cap stocks. The government has not given up on nudging corporates into investing. First, it brought back taxes on dividends. Then the recent budget of 24-25 announced that investors would be taxed when a company buys back its shares with a payout treated as dividend income and taxed as per this income slab. Until now, companies have had to pay a 20% tax rate on share buybacks. The idea is to discourage giving corporates back surplus money to the investors. It wants the companies to invest on expansions and job creation. There's a second factor which has led to the bull market, which is a change in savings pattern. For decades, capital market evangelists have dreamt of converting the middle class from investing in safe but low return bank deposits into higher return but riskier stocks. For a variety of reasons, this did not happen, mainly because India has not had a long secular bull run. The 2003-07 bull run was marked by two major crashes, 2004 and 2006. By the time it was 2008, it was time for an epic global crash that lasted for almost a year and killed any interest in stocks. The current bull run that started in May 2020 has been punctuated by minor declines in mid-2022 and early 2023. It has drawn in more and more investors. After years of poor returns from all other asset classes, investors have finally embraced equities. In 2020, after 24 years of demat, the number of demat accounts was just 4 crore. It has now jumped to 16.2 crore, unleashing a massive flood of investment, which is reflected in soaring stock prices. But the rise is backed by strong earnings growth as well. That leads us to the third factor. With government expenditure boosting growth and savings ready to be invested into stocks, liquidity has done the rest of the job. Rising prosperity in urban and semi-urban pockets and increasing corruption, leaching of massive state spending has led to higher liquidity. From the public interest angle, this has created a lopsided economy, a K-shaped one, as a few people do well and the majority do not. But as a consequence, there has been a stock boom of epic proportions. Just as nothing can stand in the way of a river in full flow, a torrent of money coming from Indian investors either directly into stocks or indirectly via mutual funds has pushed markets to higher levels. Adding to liquidity are foreign investors. In the first 4 months, in 4 of the first 5 months of this year, foreign investors were big. They have now changed tack and are now sailing with the wind. The question is, will these factors remain in place and allow the bull run to continue indefinitely? It all depends on continued growth in government revenues. If it slows down, lavish capital expenditure spending, the only engine that is driving most businesses and pushing the market upwards, will slow down. Already GST revenue growth appears to be down to single digits, which is probably why the government has decided not to publish monthly data anymore. But investors are primarily betting on the Modi government. Mr. Modi gives the impression that it doesn't matter that he doesn't have absolute majority anymore. He has retained the same team and is continuing with the same policies. This has worked well in the past 3 years. Investors find this comforting and hence expect the growth and the bull market to continue, never mind the pinpricks of higher taxes. If you like this, please do share and do subscribe. Thanks for watching.